Never was a panel more aptly named than the next one, than this one, which is Moorad and Friends. But don't start being concerned that I'm just going to have a reminisce with my old mates. Can I ask my panelists to join up on stage, please? And do we have Mr. Michael Eichhorn? Is he on here? Yep. Michael,
yes,
I can't see
you.
I can't see you though, buddy. Where are you? Turn on your camera, mate. Please.
It's on?
It's on. There we are. Right. Now, never was a panel more aptly named, and never was a topic more aptly considered than what we are about to discuss, which is, now you remember the bank failures from last year? Yeah? We had the bank failures from last year. We had Silicon Valley Bank. We had First Republic Bank. We had Signature Bank. Wasn't there another one called Signal Bank? Because there was a fourth one, wasn't there? And then there was Credit Suisse. Credit Suisse, of all firms. And they all kind of ignominiously ran themselves into the dust. And so the discussion today, very pertinent for any bank, wherever you are in the world, is bank risk management in the post-failures of last year age, recommendations for policy. Now you're thinking, well, why is it called Moorad and Friends then? Well, because they're my close personal friends. Ladies first, Diyama Abu Laban, who is head of Department of Finance and Banking at Birzeit University on the West Bank, Palestine. We have next to her my main man, Chris Westcott, who is head of faculty at BTRM. And on screen we have a close personal friend of mine, Michael Eichhorn. We could actually have called this panel with the honourable exception of Diyama, we could have called this panel the RBS, Royal Bank of Scotland Diaspora Panel, because the three of us, the three gents on stage, were all at Group Treasury, Royal Bank of Scotland, okay, but don't hold that against us. But we have continued working together. Now, where are we at the moment? So Chris is at BTRM, Diyama's at Birzeit. Michael, you were country CEO at Credit Suisse, but you're somewhere else now. Just let us know where you are.
Yeah, so I worked as a country head CEO for Credit Suisse in Ireland, and I was at Credit Suisse for over 10 years. I've seen the crisis last year from the inside, firsthand, and I'm now working for the largest German Landesbank, LBBW.
ABBW, thank you. Sorry, LBBW.
That's right.
Yes, I knew that firm. Right, let's get right into it. So I'm going to ask Chris to kick off. Just bearing in mind, just assume that we are all aware of what happened to these banks, how they managed to get themselves in trouble, how they were either sort of in some way rescued or simply wound up, US, or taken over for the price of a song in the case of Credit Suisse. Let's start with you, Chris. What would you say, based on your appreciation of what those banks got up to, and that they're all slightly different because each of them has a different case. What would be your main takeaway in terms of policy? What should banks around the world take away as a lesson learned from what happened last year? Bearing in mind, and I'll kick off with my own personal view, in the case of the US banks, there was nothing particularly new about what they got wrong, but that's a personal opinion. Chris, what do you think, sir?
Okay, thank you, first of all, everybody, for inviting me here. Michael, you're a lucky man, because you didn't suffer the travel challenges that I had. Anyway, I'm here now. So I'd just like to make very clear that anything I say here is my personal view, before anyone wants to shoot some organisation I work with. Just my personal view, and I'm hoping that I'll manage to stir things up a bit. So, first of all, I just want to give a few observations about bank failure. The first one is banks fail. Through the period 2000 to 2023, there were 550 bank failures in the US. So we're talking about a few, and you might say, well, why are we worried? Banks fail. The next observation is that some of those failures were dealt with very, very quickly by the regulators. So we could sit here and say banks fail, and the ones that happen could be deemed a success because the regulators stepped in quickly and dealt with them. However, I don't actually believe all of that. And I think there were some major failings. First of all, SVB. And we heard from the last panel an awful lot. Every other word was regulator. Now, my view is regulators are really important, and when it comes to risk management, they're important. They help to stabilize the system. However, banks should not rely upon regulators. They should be managing risk themselves, not just following the regulatory rules. Also, if we look at SVB, there seem to be some pretty basic failures of risk management. Good banks scenario plan. They look at what could go wrong and what could affect them. SVB didn't appear to do this. Also, banks, when it comes to interest rate risk management, should be looking at not only how it affects their income, but also how it affects their value. And it appears that SVB wasn't doing that. I've got a point on Credit Suisse, but we'll let Michael come in and discuss this. To me, it feels that Credit Suisse suffered because it didn't have problems in the financial crisis, and therefore the attitudes of its senior management, etc., didn't receive the jolt that happened in many other economies. And just my final point, and sorry I've gone on a bit.
Not at all.
But regulators set rules that they and banks are supposed to follow. In the case of SVB, we've got a perfectly reasonable set of rules from Basel on interest rate risk management, not adopted by small US banks. We have the case of First Republic, one of those banks that went bust, and the regulator stepped in and basically made good all depositors, not just those under the deposit insurance scheme. So what does that mean for moral hazard? I thought we got over that, but clearly we haven't. So we could take all of this and wrap it up into a policy, but I've gone on long enough, so I'll let my other panelists talk.
Thank you very much. Thank you very much. You know, just very quickly, before I get the others in, you know, you have a normal weekly catch-up office meeting or something, just a regular meeting, you're all around the table, and the boss says, yeah, just come up with some ideas. The person who goes first is always luckier than the one who comes last, because then all the points have been taken. So, Marco, you're going to suffer, my friend. Diyama, what's your response to my initial question?
So thank you for having me here, and I'm delighted to be with you, right away from Palestine. And regarding the SVB failure, when we talk about a banking crisis, it's not something happening every day. And about risk management, like it's a process, it's an ongoing process, it's a day-to-day activity, supposedly by the top management or the management of the banking sector, in the banking sector. What happened, it's purely interest rate risk, strategy, failure of strategy, or the timing matters when they applied their strategy in managing their portfolio, credit allocation portfolio or investment portfolio. So it all matters when we talk about the main function of the banking sector. It's about size transformation, risk transformation, and maturity transformation. What happened in SVP, it's failure about maturity, or what they thought that will be, but the market fails them after the interest rate went starting getting raised. So it was there. The crisis was there. It was obvious. But the thing is that sometimes the strategy of the top management, or maybe the board of directors, or the ALCO committee, fails to do, to see what's happening or what's going to happen in a short term. Their strategy was, investment strategy was long term, and what's happening in the market and the raise of interest rate goes up, so they failed their strategy. Recently, I read an article which is the recommendation was that the central banks should warn the banking sector before they apply any monetary policy in advance.
Who wrote that then?
This was one of the recommendations, and I don't know if it's still, if it could be accessible or valid in the banking sector or as in a regulatory framework. Even Yasmin yesterday, she asked questions whether the interest rate will be a quarter basis point or a half basis point. So there's a lot of uncertainty. And nowadays, when we talk about the banking sector, we are talking about different lifestyle, different generation, different technology. We've discussed earlier different topics, from renewable energy, from technology, lifestyle, generations, and every sector should be funded by the banking sector. So the banking sector are receiving plenty of needs from the market, and they should satisfy to sustain. So, and everything brings up more risk-taking or risk. So, hope I...
Well, there's plenty to cover there. Thank you very much, Diyama. I'm very glad you mentioned the ALCO, the Asset Liability Committee. Very dear to my heart, that topic. We're going to come back to the responsibilities and the objectives, responsibilities of the ALCO. Right, last but not least, certainly, Mr. Eichhorn, Professor Dr. Eichhorn, please, your views on exactly that same question. And you're not allowed to say anything that the other two said, okay?
Thank you, Moorad. First, these are also my personal views, but I agree with Chris that any bank can fail. I just want to give two other data points. In November 2022, the Nobel Prize was awarded to Dybvig and Endowment for their model that effectively said that anything, and in their model literally anything, can cause a bank run, and then all of us, we need to be vigilant. The fact that we use leverage and maturity transformation makes us inherently vulnerable. Yeah. So we need to be cognizant of false confidence. How can we address this, and what are the lessons learned? I would focus it around 4 points. The first is to build a fortress balance sheet. As you probably have heard Moorad saying, the balance sheet is everything. Yeah. The balance sheet is everything.
Definitely.
And I think what this means is, and you can see in the case of Silicon Valley Bank, that there were serious failures. It means that you look at your balance sheet maturity transformation. As I said before, Silicon Valley Bank sourced funding short-term and invested long-term, increasing maturity transformation. The sourcing was concentrated, sourcing deposits short-term from tech companies. The investment was concentrated on the asset side, investing in government bonds. So that's one part, building robust liquidity buffer, building robust capital buffers, looking at maturity transformation and leverage. That's the first point. For me, the second point, and I think that's a lesson from 2023, is the business model. We have seen a new type of failure, and I've seen it firsthand. At the outset of the crisis, Credit Suisse had an LCR of over 200%, higher than most peers.
Yeah.
Capital ratio right to the end was greater than 14%. Higher than many peers. What we have seen is a broken business model. And then if you speak to European regulators, they will say that many of the business models are not sustainable. When you look at the structural changes that were discussed before, AI, climate change, you mentioned, these are structural changes, and we need to understand how they will change our business model. And I think Silicon Valley Bank was also a business model failure. There was, Kelly once said that other banks had even larger unrealized losses than Silicon Valley Bank, but they still had the trust of their investors. They were still equitizable. So business model, focus on your business model, revisit your business model, understand how the structural changes will impact your business model is my second point. My third point has been touched on before, and it's risk management. I think it's well known that Silicon Valley Bank didn't have a CRO. It's also, I think, as I said before, they took aggressive maturity transformation. My point goes further. I think we need to come to what I call strategic dynamic risk management. Strategic for me means thinking beyond the baseline, using tools like scenario planning, using tools like reverse stress testing, really looking at the strategy. Testing, are your strategies, pressure testing your strategies, are they able to survive in different hypothetical states of the world? Can you adjust flexibility by staging investments, by buying real life options, or by any other means? So really thinking about strategic risk management, that's still a weakness. It has been a weakness 20 years ago, and it's now coming to the forefront also when you follow regulatory discourses, that we need to think more about strategic risk management. I think also governance need to be more dynamic. We should become common to wargaming, to fire drills, to different events that impact our business model and our balance sheet. And the final point I would make, and this is from the bottom of my heart, is simplify your recovery planning and resolution planning. On the recovery planning side, I've learned it the hard way, but I've surely learned it. You need to revisit your recovery plan. I think on the liquidity, clearly there's an IT element, and then clearly there's an operational element. On the liquidity side, what I can say is that less can be more. You want to, and instead of what I've learned is that the focus will be on your parent bank and on the group. If you're a smaller entity, regulators will get comfort from the strengths of your parent company. You want to focus on your regulatory metric, LCR. In a crisis, all these internal models don't matter. You want to consider in a crisis that you are expected to absorb the shock and still be compliant with regulatory requirements like LCR. So the saying buffers are there to be used may be misleading. You need to expect that you will see outflows over and above the regulatory metric. For example, we saw intraday outflows that are not even part of the LCR metric. Deposit outflows were grossly underestimated. The same in 2020, commitments. And you will see outflows due to fungibility constraints. You will see outflows due to operational challenges. You will see outflows because concepts like the historical look-back approach are asking you to update your time series, adding fuel to the fire in the middle of a crisis. You will get asked to decide on, can you suspend controls to honor others? So there's a lot that can be done here, and then revisiting your recovery plans, I think is something that's money well spent. And then finally, and then I go, on the resolution side, I think there's an article written by John Tucker, the former Deputy Governor of the Bank of England, and what he said, we should not take Credit Suisse as an isolated incident. The crisis highlighted fundamental, and he uses the word fundamental, gaps that should give regulators sleepless nights on the resolution side. He's highlighting that we need to revisit the resolution regimes in scope, so they need to be able to cover the crisis across the group, not just for one entity, in this case Switzerland. And he's also highlighting points like we should simplify our capital structure, we should think about the emergency liquidity provided. So there's a lot, I think, that can be done here for me. When it comes to recovery and resolution, simplicity is a new superpower. Simplicity is a new superpower, and I would encourage you to simplify your recovery and resolution plans. So these are my 4 points.
That's 4 points. There's about 7 there, mate. Right, thanks very much, Michael. Top man, top man. Right, I'm really glad you quoted me. The balance sheet is everything. But to be honest, I've appropriated that from the three of us, all reported to John Cummins, former Group Treasurer of Royal Bank of Scotland. That was his saying, but I've taken it forward now. Now everyone attributes it to me. I'm happy for that, okay? But I'm attributing it to John Cummins, but I'm happy if you all think I came up with it. But the balance sheet is everything, 100%. You said a lot there, Michael. I wanted to just quickly pick one up before we then go to the point in hand, which is, okay, what should we do back in our day jobs? We go back to our day job. We're all working in banks. We're not regulatory authorities, unless you happen to be one there. So we can only do what's in our own power. You mentioned about Credit Suisse and a failed business model. You mentioned about simplicity. I'm 100% all in that. With things like resolution plans or simpler capital structures, that's outside our remit. We have to wait till we're The regulators decide they're going to simplify the capital framework or simplify resolution planning. So we'll have to leave it at that. I 100% agree with you, but it's not in our power to do that. So let's get back on what we should be doing as individual banks. As individual banks, what should we take away and say, right, we're going to do this? And by that I mean do anything slightly differently or new or both to what we're doing up to now, okay? Let's start with you again, Chris, because one point you mentioned was it is our own responsibility. I myself have been getting involved in debates with one chap said to me, I don't know him, he was at a bank outside of Europe, I forget where, somewhere in Asia, and he said, oh, it was the fault of the Federal Reserve. If they hadn't raised interest rates, Silicon Valley Bank wouldn't have gone bust. What? I thought that's what central banks do, move interest rates. That's what they do, isn't it? It's their job. You know, when you come to a traffic light, you expect the traffic light to move from red to green and back again. It's their job, right? So I didn't hold truck with that. Let's go back to one of your points, Chris, which was with respect to what we should be doing, what we can be taking forward. Own responsibility. It is our responsibility to make sure our balance sheet is everything, as Michael said, a fortress balance sheet. That's the Jamie Dimon expression. Is that if we buy into that, we can work towards that. What should we do towards making that happen? Our own responsibility. I want to ask that. And also, who is the responsible body? Is it the ALCO? Everyone says it's the board of directors, but they don't do the day-to-day management. So what can we be taking away to do to respond to this, to make sure it doesn't happen to us? I guess that's my question. I'll start with you, Chris, and then I'll go to the others.
So the first point I'd make is scenario planning. It has been mentioned by us. There's numerous examples if you look back over history. So going back 40 plus years, Shell benefited from the oil crisis. Why did they benefit? Because Shell undertook scenario planning. All the other players didn't. And also, as part of that scenario planning, Shell had rejected the status quo, because we all know that a really good scenario should have three aspects. It should be severe, it should hurt. It should be based on your key vulnerabilities, and it should be plausible. And what Shell did is, based on that, they looked in the future and they decided that the status quo could not happen because it wasn't plausible. So they looked at what else could happen and what they would do in those circumstances. And having done that, they had a plan when the oil crisis came along. No one else had a plan, Shell benefited, all the others didn't. So that's one key point. My second point, and I said this is based on my own views, but I think the balance of power is wrong. We're in a situation where the board of directors have all the power. They don't necessarily listen to the regulator, they don't necessarily listen to the rating agencies, and they don't necessarily listen to their staff. And the net result is those failures that I've been close to have all been characterized by the same thing. There are staff in the organization saying this is a disaster, and the top management are not listening because of the incentivization. The incentivization of the top management, they're employed, they want to increase the share price, they want to earn profits, they want to boost their bonuses. And although you may think we got rid of that in 2007, we clearly haven't, okay, in my view, or not fully. So there's a couple of things there, but basically you cannot do enough scenario planning. Hopefully Michael will support me on that. And the second point being that the power base is slightly wrong. The regulators don't have teeth. Always. And the skills of the staff, regulatory bodies employ public servants, people who want to do good for the community. And they always seem to be at a disadvantage compared to the senior bank management. I'll shut up now.
No, actually, I agree with everything you said, but I just want to pick up, before I go back to the other two, I want to pick up on the regulators don't have teeth. I mean, you mentioned quite rightly that smaller banks, and by the way, SVB wasn't small, they had a 250 billion balance sheet, but they were in the tier one, so they didn't follow Basel guidance, so they weren't heavily regulated. But Credit Suisse, I mean, they had regulators coming out of their ears. I remember, Michael, do you remember you invited me onto a call to discuss, I couldn't make it, but there was a call with when you were at CS on interest rate risk, and it was an ECB call, wasn't it? It wasn't the Swiss National Bank. So here we have a bank that is regulated by its central bank and the ECB. They were heavily regulated, and yet they still fell over. I mean, failed business model, I think maybe it's a risk culture point, very poor risk culture. I really buy into the point about there's an imbalance of power. You're quite right. The three of us all know people at RBS who knew what they were doing was madness, but no one was listening to them. The senior execs weren't listening to them. The people in GBM weren't listening, investment bank. So that's I don't know how we will address that. Maybe I don't know how we change that balance of power, but that's a very valid point. Now, I want to come back to the other two on policy takeaways, and you're not allowed to say anything that Chris said. So policy takeaways, what should we be doing to address all the problems that the three of you have already identified, in addition to what Chris was saying on imbalance of power and scenario testing, or what if? Each of you in turn. Do you want to go, Diyama? Any thoughts?
I don't mind.
No. Or Michael, do you want to jump in?
Yeah, I can jump in. So I would lay it out. So what can we do across the four dimensions that I laid out before? First, with regard to the balance sheet, and then the balance sheet is everything. This idea of
yes.
fortress
Let's say that again.
Sheet,
the balance sheet is everything. Moorad Choudhry.
But what it means, this idea of a fortress balance sheet that also Jamie Dimon and enforced at JP Morgan, it meant that he asked his managers to not only meet the regulatory requirements on liquidity and capital, but to be stronger than peers. And that was underpinned also by the ask to use the most prudent valuation.
Let me just stop you there quickly. Now, that's a great philosophy. I love that. But we can't all be stronger than our peers, can we? So we can't all be at number one. So I personally love that philosophy. But where should we go? If there's 20 banks in our peer group, only one of them can have the biggest capital ratio or the biggest LCR buffer or what have you. What's a more general takeaway on how strong the balance sheet should be?
I think the more general takeaway for me is, and that's from SVB directly, is we need to understand the optionality in our balance sheet, implicit and explicit.
Yeah.
I think there was a gross underestimation of the implicit optionality on the liability side. I think we also need to better understand the time dimension of the balance sheet. For example, in Europe, their average loan was granted prior to the financial crisis. Prior to the COVID crisis. Since then, a lot has changed, including the interest rate level. The average loan only expires in the next decade. Who knows what the geopolitical environment will be, but it means our balance sheet, your balance sheet, has a time dimension that we need to understand, and we need to see if the balance sheet is robust enough to deal with this changing environment. That would be on balance sheet. On my strongest feeling are related to the business model. So by business model, I mean effectively the business model canvas. Your key partners, your value proposition, your customer relationships, your customer segments, your revenue streams. I would encourage everyone to really ask himself, do we understand the strengths and weaknesses of our specific business model well enough?
Yeah.
Do we understand how the changes that we see play out in front of our eyes will change our business model? Our business model, if you want it or not, it will evolve. And then do we understand it, and then can we build a business model that is robust for this new environment? Then on my third point on risk management, I agree with Chris. Scenario planning is ultra important, and then should be done much better than it's currently done. There was a GAP study just last month highlighting that 2 points. Geopolitical and climate risk stress testing is still underdeveloped compared to other risk streams. And the other more alarming point, business executives are often not involved in these exercises. It's purely done by risk management.
Very true.
I think there could be a quick win there.
Sorry, Michael, I didn't mean to interrupt. I was just 100% agreeing with you. They don't, at the senior exec level, which is allied to the power imbalance point as well, they don't get involved at the level they should to really understand the balance sheet. 100% agreed. Please carry on.
Yeah, so then I think we need to move to dynamic governance, also touching on the ICO. as part of, I call it generic stress testing, rather than trying to predict a black swan, which may be impossible, our track record is terrible. There are tons of behavioral science articles saying how difficult it is for us to predict the future. Rather than doing this, we should focus on resilience. Can we withstand a certain level of shock? And that should be the discussion in ICA, that should be the discussion in other governance committees. And we should also play it. It's not only having the scenarios, but using them in governance committees to say, to pressure test our strategic initiatives, to pressure test our KPIs, to pressure test our balance sheet. What will it look like in these hypothetical future worlds? So I think a lot can be done there. And on recovery planning, I've laid out the points before, but I think if we are honest, there was, prior to the crisis, was assumption that you go from BAU to recovery to resolution. What happened in 2023 was we went straight to resolution.
100%. I was waiting for you to say that. Thank you very much. No, because the recovery plan should be done away with, because it's obvious that 3 different regulatory authorities went from business as usual to resolution in a weekend. So that's 300 pages of time and effort and consultant fees we can do away with. But hey, that's up to them. Now, thank you very much for that, Michael. You're a man after my own heart. One last thing. You said the governance body should be involved. Do you mean the ALCO or the board or both?
I mean both.
Gotcha.
But I think what is important is we need to work way more on strategic risk. I think there's a tendency to become very sophisticated on market risk, on credit risk, on all types of financial risk, increasingly also non-financial risk. But strategic risk, this array of external events that can devastate your trajectory.
You've got to stop, Michael. I'm going to start crying in a minute. It's too emotional for me. You're so spot on here. I'm going to start crying. You're spot on. That was getting very emotional for me. Now, 100%. Thank you very much. Diyama, is there anything that academia can do to assist? I mean, academics in finance and banking don't... Finance and banking is the only discipline that I can see where there's a disconnect between academia and practice.
You think so?
in civil engineering, in petrochemicals industry, in medicine, naturally, there's a close connect. The practitioners read academic papers know what happens in practice. I've never come across too many, other than the 3 people here in this room, the 3 gentlemen in the room, too many practitioners who read an academic paper on finance and banking. What can academia do to help this policy change that we've been hearing about?
Yes, I was planning to respond in academic way, and so you got me. Whether the banking sector or the banks operating as an aggressive strategy or a conservative strategy, of course, after applying or adopting to comply with the regulations, even if we assess the practitioners here, the head of the Treasury Department or CEOs, definitely, if we assess their strategy, definitely it will be different. So whether they apply aggressive or conservative strategy, there will be a variation with their strategy applying different allocation of credit or investment. So in the academic, and which the practitioners usually don't think about it, I don't want to generalize it, but they don't think about the opportunity cost to apply this strategy or that strategy. Some practitioners even, they don't calculate the opportunity cost of applying this and that. Failure of banks that's concentrated or their credit allocation customized or concentrated on one sector, it's not like it's not a resistance to still funding this sector. SVP, they were targeting the entrepreneurs, the startups, the technology. Yeah. Back in the 80s, since the financial liberalization and all of in the Middle East especially, after 5 or 6 years, we had a banking crisis in different countries, and they apply different allocation in their credit or in the investment, and after the crisis, then the financial crisis. And this, it should not prohibit us or prohibit the banking sector to fund different sectors. Yeah. For example, there are a lot of papers about the early warning system for the OECD countries or for the MENA region. And it's well known that for the OECD countries, liquidity matters, leverage matters, property prices matters. For the MENA region, it all comes to macroeconomic variables. So the variable, it's there. So how to assess or how to replicate what's the changes in the market, it matters. With the scenario testing, with the stress testing, what will happen, like if they raised the interest rate, for example, half basis point or quarter basis point, or they took a decision not to raise the interest rate. This should be applied in the top management or the ALCO to conserve or to monitor the performance of the bank. So, yes.
Okay, no, thank you. Thanks very much. Right, thanks all of you. Okay, right, let's open. Where's my roving mic person? Just need to wait for the mic, sir. Have we got a roving mic? No? I catch him out every time. Thank you very much. The gentleman here on the second row, just on the left. Just your name and firm, please, sir, if I may.
Thank you. My name is Ayman. I'm the CEO of National Bank Iraq. Well, the sentence, balance sheet is everything, has been repeated many times during the conversation. Well, I think governance is everything. I think with the right governance, we'll be having a right balance sheet. I think central banks in general and banks as well, they should reconsider the composition of board of directors, board committees, executive committees, maybe adding more independent members on the board level and on the executive committees level. I think the governance is the key word. And as you all know, failure doesn't happen suddenly. It takes time to fail. So I think the governance and the moral ethics of all parties, I think, is the most important thing. Thank you so much.
No, thank you. Thanks very much. And by the way, I did know who you were. I did know who you were. I was just Ayman. I was sitting for the other. I hadn't forgotten. Right. Did you want to comment on that? I think he was making an observation. I hadn't agreed with him. But do you have any comments on that?
Yes, I agree with that. And the picture that I've got in mind is like a pyramid. For me, the foundational layer is a balance sheet. But then as you move up the pyramid, similar to the pyramid of needs of Maslow, the next layer for me would be the business model. And then under risk management, there is this governance element that the gentleman rightly pointed out.
Thank you very much. Chris, I think you want to jump in there as well?
I think another word is important, and that is incentivization. I think we've improved a lot, but still, as I go back, the way managers are incentivized is not ultimately always leading to the right answer.
Okay. Any other questions in the audience? I'm looking for a hand. No? No hands? What about the chap earlier who said who uses LinkedIn and no one put their hands up when I bet everybody's on LinkedIn? What was that about? Right, no, I don't use LinkedIn. Right, any more questions from the audience? No? We're happy? Okay, in which case, for me personally, there's lots to take away. Thanks very much, everybody. I took away, it's our own responsibility, the bank, it's not the regulator's job, it's our responsibility. I took away the importance of governance that we just heard from Ayman and Michael. I took away incentivization. I took away the importance of the ALCO. Took away the importance of understanding not just a fortress balance sheet, or balance sheet is everything, but also the sensitivity of the balance sheet to changes in external factors, which are often outside our control. We need to be on top of that as individual balance sheet managers. If there's anything else I didn't take away from that, please remind me. But no, thanks very much, everybody. I just wanted to thank, and to the audience, I wanted to thank my close personal friend, Michael Eichhorn, my close personal friend, Chris Westcott. I love them like my own brother. And my close personal friend, Diyama, who I love like my own sister. Thanks very much, everybody. Appreciate it.
Thank you.
Michael, thank you. Take care of yourself.
Thank you.
Right. Chris, thank you. Right, so we are at lunch. running more or less to time. Thank you very much. Running more or less to time. I just got a couple of admin announcements for you, okay, because I also double up as the admin person here. Those of you who are going to Wadi Rum this evening, but might be leaving tonight, for example, on the midnight flight out of Aqaba, just let the organisers know, because they need to get you back in time after the Wadi Rum trip. Also, if you're going to Petra tomorrow and you have a flight on the same day back to your home location, let the organisers know your timing, okay, so you're back in time to go. I will wish you a good lunch. Please come back on time at 2 p.m. So it's 55 minutes from now, more than enough, right, to get a good bite to eat. I'll see you back at 2 p.m. for the next slot. Thank you very much. Have a good afternoon. Thank you.